How's it going, guys? Welcome back. In today's video I'm going to show you how you can go ahead and choose the most high probable and the best fair value gap when it comes to trading fair value gaps. Now there's multiple ways that we can do this, so if I just bring up my little demonstration right here and my little sort of diagram, as you can see this is sort of a bearish example. It's the same whether you're bearish or bullish, it doesn't really matter, and this works on all time frames because, as you will know, price action is fractal, so this is applicable to any time frame. So kind of what we've got in this example right here, right, is we've got a bullish order flow coming up, and then we get our market structure shift and our break to our downside, and then what happens is we then put in a fair value gap somewhere around here, right? So this would be our entry, but sometimes what might happen is we might get fair value gaps sort of down here, and then you might be thinking to yourself, do you use this one? Do you use this one? Maybe there's one a little bit further up, maybe there's one up here. But you get the idea, sometimes price will put in multiple fair value gaps and then it will leave you confused on which one you will then use. So the overall easiest way that you can do this is if we go ahead and get our gam box, and then we put our gam box from the top to the bottom of this little swing leg right here. As you can see, this fair value gap is situated in premium of this displacement leg, and in this case this is the one we would use. You can also use this alongside different confluences. So let's just say we just get rid of that one, for example. What you would do then is you could go ahead and get your OTE, so OTE from the displacement leg, from the top to the bottom. And if you don't know, obviously the settings, if I just show you the settings for the OTE. So these are the settings right here, right? So 0, 0.62, 0.79, 0.5 and 1. And then that will then give you this, fib right here. And then as you will notice, the price will then trade up back into the level of the OTE. You could then trade, toward the downside, stop over the highs, and then this would be your entry. You can also pair this with, concepts like breaker blocks. So let's just say, for example, we've got a breaker block, right here, lines up perfectly with the breaker block. You can also use this in line with balanced price ranges. So potentially a balanced price range right here. If you don't know what balanced price range is, it's basically just displacement up, displacement down, leaving fair value gaps on either side, and then you can, trade from the balanced price range. But the overall easiest way, like I said before, would be to use the premium and discount or the OTE fib. So as you can see, from top to bottom, price trades up into our OTE, and then we can go down and sort of, enter the trade with confidence that price will return to this. So what we can do now is we'll go into the charts, kind of look at a few examples and see how we would use this in a real life scenario. So first of all, we've got Euro USD, right? And what you will notice is we've come down, we've taken liquidity below these lows. And then what we've got is we've got our market structure shift sort of around this area, right? So we've got our market structure shift right there. And then as you will notice, the displacement leg is a really big displacement leg, and there's a fair value gap right here. So there's a fair value gap there. There's a fair value gap right here. There's a fair value gap just below that right here. So you've got multiple fair value gaps right here to choose from, right? And the overall easiest way, as I said before, to do this is to take out your premium and discount. So premium and discount from the bottom to the top of the displacement leg. And then what you want to do is you want to choose the first fair value gap inside discount or inside premium if you're going bearish. So what you could do is you could take it from here to the premium and discount. You could then set your entry right there. But for me, what I would want to do is I would want to choose the first proper fair value gap within discount. So for me, this one would be this one right here. And then as you can see, it comes up, we get our market structure shift, price trades back down into this perfectly. This would then be your entry. You could put stops below the lows, or you could put stops, below this candle right here. And then you could trade sort of up to buy side liquidity right up in here, or wherever you want to take profits. So that's the first example right there. We will now move on to GU, a different currency pair. And again, we've got a very similar scenario. As you can see, we come down, we take sell side liquidity, we then get a break to the upside right here. Put our discount and premium leg on, so from the bottom to the top of our displacement leg. Fair value gap right here situated within discount, the first proper fair value gap within discount. And then as you can see, what we do is we come down, we trade back into it perfectly, and then away we go. The next example will be on GBP AUD. So again, as you can see, it doesn't really look like we've taken any liquidity, but in this case right here, what we've done is we've come into a 15-minute order block. So as you can see, we've traded into this order block right here. Overall, we've got bearish structure and bearish order flow. So if we jump down now onto our entry time frame, as you can see, tapped into our point of interest, we get a displacement leg down, we get our market structure shift right here. So market structure shift right there, and then as you can see, we've got fair value gaps there, fair value gaps here, fair value gaps up here. So what we can do is we can go ahead, put our premium and discount on from the top to the bottom of our displacement leg, and if I zoom in, so our first fair value gap that we would want to enter from, fair value gap right there, entry on the FVG, stop above the highs, or you can either put it on top of this swing high right here, but here would be, sufficient, and then you could trade towards, pretty much wherever you want to target. So, there's 3 good examples right there on how you could go ahead and enter the market if you've got multiple fair value gaps. So sometimes it might not be picture perfect, and it might react from a fair value gap that's higher, it might react from a fair value gap that's lower. So that's why you want to make sure that you're covering, swing highs, so this one or this one, just to keep your stop loss protected. But overall, what you will do is you will see most of the time what price will do after the market structure shift is it will come back up into a premium, fair value gap, and then it will react from there and then continue if you are going to continue bearish or continue bullish, whichever direction you are trading in. So that's pretty much how simple it is, and what I'll do is I'll just mark out the OT level of this. So as you can see, displacement leg right here, mark it from the top to the bottom. What you will notice is price trades up into our OC level and then trades down. So these are all concepts that you can use, but the most simple concept is the premium and discount tool when it comes to choosing your fair value gaps if you have multiple. So it's just that simple. If this video did help you out, please leave a like on today's video. If you have any questions, feel free to drop them in the comments. I'll try to reply to every single one of you. And without further ado guys, thank you very much for watching, and I will see you in the next one.